Hello, it's Randi Rhodes. Here's a clip from our show, and go to randyrhodes.com for the whole thing and a podcast. Buy a stinking podcast.
Mary had a little man.
The fault. We believe that all men are created equal.
To the magnificent mosaic that is America.
From radio beacon to radio beacon. I have a dream today. Change has come to America.
Believe me.
Knock, knock. Who's there?
It's a figment of your imagination.
Randi Rhodes Show.
Turn up your mind.
The wealthiest taxpayers in America could soon get another tax break.
What?
The Treasury is considering a change to capital gains tax that would result in a $100 billion tax cut for them, according to the New York Times and the Wall Street Journal. Before we can discuss the pros and cons, let's explain how this would work. Capital gains are profit from the sale of property or an other type of investment like stocks. You know, what rich people have.
Right.
Currently, we tax capital gains based on the difference between the purchase price and the sale price of an asset.
Right.
The sale price is called cost, and current rules allow for investors to recoup that sales price, the cost. The cost is taxed at a rate of 23.8%. If you invested a cost of $1 million in 1990 and sold that asset for $3 million this year, you would only owe the tax on the difference. That's $2 million. Your tax bill would be $476,000. Well, the Treasury Department could change the definition of cost when calculating the capital gains, allowing for investors to account for inflation when determining their tax liability. The same investment of $1 million in 1990 would now have a cost of about $2 million in today's inflation-adjusted dollars. That means the investor would only owe half as much, $255,000 in taxes. Compare that to the $476,000 without adjusting for inflation, a difference of $220,000, and that's tax dollars the Treasury Department loses out on. This kind of change could result in an estimated $100 billion in tax savings for wealthy investors. It would also dig into the Treasury even deeper, the hole that they are already in from the last round of tax cuts, which again mostly benefit the wealthiest Americans.
Oh, my God. It's not just me saying it. It's the Wall Street Journal saying it. It's the New York Times saying it. It's every reporter that covers finance is reporting breathlessly today. Holy crap. Work is going to be taxed, but making money, they're going to have your obligation to pay taxes, and the Treasury, the debt and the deficit is something we're going to get stuck paying. The difference between what the Treasury takes in and what the government spends, we have to pay that. And so we're going to foot the bill for another. We already paid $1.5 trillion to give the wealthiest people a tax cut. Now we're going to have to add another $100 billion so that they can, just laugh all the way to the bank. And the sick part is the really, really undemocratic part, the really, really un-American part, not go through Congress to do it. Not go through Congress to do it.
The Treasury Department is in a hole because the tax cuts from 2017 are still not paid for. There's this Republican idea that if you cut taxes, it's going to spur growth. Even if it spurs some growth, not enough. The corporate tax cuts thus far have not trickled down to the American worker. In large part, they've resulted in stock buybacks. Who does that serve? The shareholder. Who does capital gains adjustment serve? The shareholder, not the American
But
worker.
our entire tax system is based around preserving money for the wealthy, right? Labor gets taxed more than wealth does.
Thank
if you
you,
have assets
Allie.
and you have capital gains, your tax rate is lower than if you just work for it. So this is just a perpetuation of a problem we've had for a few hundred years in America. It's supposed to be getting better. It's getting worse.
It's not a new idea. Larry Kudlow has liked this idea for years. What's stunning is it's what the president campaigned against, much like when he said he was going to close the carried interest loophole, yet miraculously it stayed in the tax system. And now here we are again, and it's certainly a gift to the donor class.
And they don't even mention the fact that Steve Mnuchin would like to effect this change without going through Congress, adding $100 billion to the 1.3 or $1.5 trillion this tax cuts already cost us. Now they want to add another $100 billion for the top 1/10%, and we have to pay for it, those of us who work. this is just so and by the way, the numbers are in about this tax cut and whether or not this tax cut. Remember, the Republicans always say tax cuts pay for themselves. It'll pay for itself in business investment. It will pay for itself in new jobs. I hate to tell you that this economy is now starting to hemorrhage jobs, and that is because of his ridiculous trade war, his stupid tax on steel and aluminum, which is forcing people who make things to lay off their workers. Seriously. You have Jane Hardy. This is the Washington Post. They decided to tell the story of a couple of small and mid-size businesses who have been in existence for 100 years, okay, making things, and how they're now having to lay off their employees because their costs are enormously skyrocketing due to these tariffs. So they talked to Jane Hardy, who is the CEO of Brinley Hardy. Brinley Hardy has been in business since 1839. They make lawn care equipment. She had to lay off 75 employees this summer because of the trade war. She's in southern Indiana. She's one of several manufacturers in the heartland who are trying to send up a flare to tell Donald Trump that unless they see relief from these steel and aluminum tariffs, the job losses are going to mount and factories are going to close like hers. There is a nail company in Missouri called Mid-Continent Nail. They were the first to send out the clarion call to Donald Trump saying they're in Missouri. Like I said, they are the largest manufacturer in the United States of nails. And I don't mean, pedicures and manicures. I mean hammers and nails, that kind of a nail, okay? And earlier this summer, it laid off a whole bunch of workers in Missouri because of the tariffs on Mexican steel, which is what they buy. And they have said they are looking at closing their doors for good Labor Day, which is what, September 8th? Next month? I mean, it's July 31st. You've got the month of August. He's got one more month to be able to import stuff, right? Now, there's another one. There are small companies, mid-sized companies that are especially vulnerable to these tariffs because they can't absorb the cost. They can't shift their production overseas the way Harley Davidson can. And even Harley is telling them, well, we're going to have to add $2,200 to the price of a motorcycle. You got a guy who makes snowmobiles. His name is, the company is called Snow Joe. They make snowmobiles. They make lawn and garden equipment. They're in New Jersey. They employ 300 workers, okay? And this man named Joe Cohn, Joe who owns Snow Joe, he actually said to the White House last week in person, he said, these tariffs are killing our business. We're going to have to, we were planning on a major expansion. That's not only off the table, but now I'm looking at letting go 100 workers. That's a third of his workforce. Harley Whirlpool, who was so excited about taxes on the import of washing machines, right? They were thrilled with Trump's tariffs until they learned he was going to also add steel. Now they're freaking out because, oh no, the costs of making the dishwasher have skyrocketed. Caterpillar, same thing. Coca-Cola with their freaking aluminum cans. Coca-Cola is doing this kind of on the sly. Here's what Coca-Cola decided to do because they are raising the cost of a can of Coke. So are beer manufacturers are raising the cost of beer because most beer, I won't say most, but a good amount of beer is sold in cans, some in bottles, but some in cans. And they're saying that they also have to raise costs. So what they're going to do is they're going to raise the cost to your local retailer. They're going to charge your 7-Eleven or your Winn-Dixie or your Piggly Wiggly over there. They're going to charge them more for their orders of cans of Coke or cans of beer. And then each retailer is going to have to figure out how do they absorb the cost. And the answer is going to be pass it on to you. This is all leading to inflation, meaning things are going to cost you more. And that just ties in so beautifully with wanting to tie capital gains to inflation costs and wanting and watching Russia dump U.S. treasuries, which is the debt. That is the debt. That's how our debt is financed. They always say, oh, it's a bunch of IOUs. It's not IOUs. They're U.S. Treasury. They're bonds. And Russia just dumped 75% of their U.S. treasuries that they hold. Now, it's not, total panic, because if China does it, we're screwed. We're screwed because China holds the majority of our debt. But isn't it interesting that Trump meets with Putin and all of a sudden Putin makes this big decision to offload treasuries, and now Steve Mnuchin is running around saying, well, we want to give another tax cut. We don't want to run it through Congress, especially ahead of an election, because God only knows, these people who are bleeding jobs in the heartland, like Caterpillar and, Harley and Whirlpool and Coke and these nail companies in Missouri and this, Brinley Hardy company that's been in business since 1839 might not be able to, weather this, because it's going to be huge. They're laying off employees, and your wages, by the way, the numbers are in, as I said, your wages have not kept up with inflation. Your wages are actually falling. We went over this yesterday, but here is Bloomberg. Okay, this is so sick. The tax reform has not resulted in higher wages for American workers. Real hourly compensation actually fell for the first quarter after tax reform was passed. And here's the thing, there's no government data, there's only private company data, and PayScale is who tracks that. And PayScale has an index of real wages, and it shows a dramatic deterioration of real wages in this period. After the tax cuts, the first 2 quarters, in this period, your wages fell. It's not keeping up with inflation. And there's no business investment. They decided, the very, very, CEO-ish, the CFO-ish, the, titans of industry, they decided to buy back their own stocks instead of making capital investments, instead of expanding the business, instead of buying more production opportunity, expanding. They're using buybacks instead to enrich just themselves. $700 billion of the 1.5 trillion went to them, and they paid themselves $700 billion, but they did it through capital gains, stock buybacks. And now it's tax time, or it's going to be tax time, and they don't want to be taxed on that. So therefore, the tax cuts will not pay for themselves. And growth is, I know you see this big number, 4.1, but that's because countries were stocking up on American soybeans ahead of the tariffs. And they were just stocking up and stocking up and stocking up. And that's where the GDP increased. And that's a one-time thing because now the tariffs are going into place. And in fact, there have been very tepid increases in business investment. There have been decreases in real wages and increases in share buybacks and capital gains. That will not pay the deficit. It will not. And they said the tepid rate of growth means that the tax cut is unlikely to pay for itself, which has always been my lonely little position. And I won't even say lonely. It's been my position and every decent economist's position since they, the Republicans saw a dupe, saw an easy mark in Donald Trump and said, now's the time. Get these freaking tax cuts done. Now's the day. He'll sign any damn thing. He doesn't know about the economy, and we'll get him to parrot. It'll pay for itself and it'll expand, opportunity. But the truth is, supply side economics does not work. Every economist has told you supply side doesn't work. Tax cuts don't stimulate the economy to reduce deficits. They just don't. They used to. I'll give you this. They used to because after World War II, we had 90% income tax rates on the very wealthy to support the war. To support the freaking war. And so a way to improve the economy was to lower taxes. because they were at 90%. But now taxes are so freaking low, and they have been for so long because Bush did a massive tax cut. Obama did some tax cutting. So now the tax cut, the tax rates were so low that any tax cut, in addition, would just cost workers money. People who weren't in the top 1/10 of 1%, who weren't paying, high tax rates to begin with. We would suddenly have to pay more for health care. We would suddenly have to pay more for everything. And it wouldn't stimulate the economy because the tax cuts for the wealthy were their tax rates were so low to begin with. So, lowering the corporate tax rate when the corporations were able to exploit all the loopholes that were available to them and pay zero taxes to begin with, GE paid zero. Before the Trump tax cuts, they paid zero. So lowering the corporate tax rate just took money out of the Treasury. It didn't do anything for business investment. And of course, it bled the Treasury more. And we have to make up the difference. And that isn't even enough for them. Now they want more. And they don't want to go through Congress. This is frightening to me. I have to tell you, this is frightening. I don't even know how I'm going to make you wake up. I don't know how I'm going to get people to register to vote and just do it. Go to RandiRhodes.com for the whole thing and a podcast. Buy a stinking podcast.